Is the tax-free retirement indexed universal life pitch realistic? Hi, I'm Brandon, founder of the Insurance Pro Blog and licensed insurance agent, and I've sold a fair share of indexed universal life insurance policies throughout my career. So today, we're going to dive into whether or not you can believe all of the information you're being told on the internet about the income capabilities in a tax-free retirement that can be brought to you by indexed universal life insurance. There is a lot of buzz being generated about IUL and its ability to create a tax-free income and a mighty high income at that. This is not particularly new when it comes to indexed universal life insurance. When the product first came on scene during the 2000s, it was much hyped for its supposed ability to provide market-like returns without market-type volatility and losses. But, as should be fairly anticipated, it's also come with a number of detractors who have spent much time casting doubt on the viability of indexed universal life insurance to deliver on the promises it reports. So, the obvious question is, are the numbers reliable? And the answer is, it depends. It depends because it really hinges on the assumptions that get made, which we're going to dive deeply into today to give you a full understanding of what IUL is capable of doing and what it really can't even kind of sort of do. So our discussion today about indexed universal life insurance is going to cover two broad categories. First, we need to understand and believe the accumulation story. And second, we have to understand and believe the income story. Indexed universal life insurance earns interest, which is payable on the cash value of the life insurance policy. This interest is determined by the movement in an index that the policyholder chooses from the options inside the specific insurance contract. In some cases, there is only one index, but in a lot of other cases, there is a multitude of indices from which to choose. Making the product even more robust and unique is the fact that you can allocate to multiple indices with the cash value you have inside your life insurance policy. So you can actually create a broad amount of diversification across different asset classes and even different stock markets around the world to spread your overall exposure and return possibilities based on different things that unfold under different markets and different asset classes. But just because we're following an index, like for example, a stock index, more specifically, the US equity stock index like the S&P 500, does not necessarily mean you are going to achieve returns that are on par with what you would expect if you were to just regularly invest passively in the S&P 500. In fact, the chances that you will match or beat stock market performance by using indexed universal life insurance is nearly zero. And there's a whole host of reasons why I say that we're not going to litigate today. Just understand that indexed universal life insurance is not going to produce the rate of return you would normally expect if you were to just invest in the S&P 500 through something like an indexed ETF or index fund. But the interest that you are going to earn on cash value in an indexed universal life insurance is generally higher than the interest that you would earn on other fixed interest life insurance contracts, like regular universal life insurance and even whole life insurance. And the degree to which you will receive a higher rate of return in an IUL contract is very dependent on the index options that the insurance company makes available under a particular product, as well as the features that go into the ultimate calculation for the index earnings. These are things like cap rates and participation rates, which I'm going to skip an explanation on today in the interest of time. But we do have other videos dedicated to explaining exactly what those are as it relates to indexing and insurance products. So when it comes to the projections that you're going to see for an indexed universal life insurance policy proposal, we as agents need to make an assumption about the interest that will be earned on average over the lifetime of the indexed universal life insurance policy. Now, every IUL policy issued in the United States does have a default rate set by the insurance company. Normally, these default rates are a bit lofty in terms of what they report is likely to happen with the IUL policy. And so refinement downward is necessary. This has gotten much better over the course of the past maybe 8 or so years. Prior to that, life insurance companies were able to make some wild assumptions about what the indexing features of an IUL would produce in terms of actual interest paid on cash value. And it resulted in a lot of lofty expectations that were dubious to be very, very nice. And unsurprisingly, never ever came to fruition. So the big question that comes out of this entire discussion at this stage of the explanation is simply, what is a reasonable interest rate assumption that will drive the projected cash value growth in the IUL contract? I've spent an inordinate amount of time running various indexed accounts at a whole host of different insurance companies through a number of models to try and figure out what a reasonable average is. And in general, something that falls at or slightly below 6% as an assumed interest rate has been a very, very solid number for the sake of modeling. In fact, we now have policies that have been in force for over 10 years that we've been able to go back to and review for actual performance. And those policies have, for the most part, exceeded that 6% target that we set when we put the policies in force. There's even a policy that we regularly talk about with updates at the Insurance Pro Blog podcast that's been in force since 2012. The original assumed interest rate that we used to model future cash values was 6%, and the policy from inception to date has averaged 6.48% for the index credit. That does not mean I want to use a higher assumption moving forward, because there's still a number of things that could drive the overall earnings down that have to do with company particulars, but also just the idiosyncrasies of how timing impacts the actual rate of return of an indexed universal life insurance policy. While it greatly reduces the impact of sequence of returns, it is not completely immune to the effects that concept can have on the accumulation of cash value and what one can do with the money that is housed inside the IUL contract. So in general, for any indexed universal life insurance policy being issued today, some number between 5.5% and 6% is probably reasonable, so long as the cap rate on something like an S&P 500 indexed account is above 9%. Below that figure, we might use something closer to 5% as the number to project out cash values from there. That doesn't mean the policy won't achieve something like 6% or better throughout its lifetime, but it does mean, for the sake of making reasonable expectations, we do need to temper our projections in order to not overpromise and underdeliver. The next stage of our discussion is what we'll call the income story. And the income aspect of this also needs you to believe in the accumulation assumptions that have been put in place for the indexed universal life insurance policy. You could be very okay with the accumulation assumptions for the indexed universal life insurance policy, but quite doubtful on the income side. And truth be told, that doesn't mean indexed universal life insurance won't work at all for you, but it would be mighty, mighty difficult, practically impossible in setting you up for failure if you decided that you were a big believer in the income story of this discussion, but very, very dubious about the accumulation side. When it comes to taking income from an IUL policy, you are most probably going to make heavy use of loans. While some people may withdraw cash down to their cost basis and take loans after that, for the most part, indexed universal life insurance works better when we use loans almost exclusively for the sake of generating income. This happens because of one of the two types of loans that are available under most indexed universal life insurance contracts. And to cover that real quickly, there are two loans most usually available on an IUL contract. A fixed loan, which has a fixed rate of interest that is declared annually by the insurance company, and will at that point tie the cash value that acts as collateral for the loan to that fixed loan of accumulation. The interest being accumulated on the loan may not match the accumulation of cash value perfectly, but most companies will bring them pretty close to one another, if not identical, at which point we call that a wash loan. The other loan option I'm going to broadly categorize as the indexed loan option, and there are some refinements to this, I do get that. But for the most part, this is a loan that allows the policyholder to continue to have cash that is acting as collateral for the loan to participate in an index, which means they have an opportunity to earn more interest on the cash that is acting as collateral than will accumulate on the interest on the loan. For those who are familiar with whole life insurance terminology, you can think of it in a similar context to what we call non-direct recognition, where a dividend is paid regardless of an outstanding loan balance. And in general, we anticipate the payment of dividends to be higher than the accumulation of interest on the loan. There was a time back in the 20-teens and prior when very little regulation existed to police how insurance companies assumed their index loans would work. This led to a number of companies or insurance agents and or insurance marketing agencies to assume the very best possible index assumption and the very lowest possible loan interest rate for accumulation, and led to massive spreads between what we thought the loan would accumulate at and what we thought the cash value in the policy would accumulate at. And this resulted in astronomically high income numbers being generated from the reports that illustrated the potential loan capabilities of the indexed universal life insurance policy. If you had any mathematical acumen, you would look at this and think that doesn't seem like that would hold up. But understanding the notion that life insurance contracts are new and somewhat nuanced to most people, so they don't necessarily understand all of the ins and outs of what's being assumed, a number of people might have taken those values at face value and bought a policy under unbelievably optimistically inflated assumptions. Thankfully, as we got to the end of the 20-teens, new regulation came about that substantially reduced a lot of the assumptions that could go into the way income projections worked with indexed universal life insurance. But there's still a little bit of refinement that may be necessary for most situations, and it's really prudent to question the income figures that are being projected from an indexed universal life insurance policy. The best, quickest, easiest rule of thumb that I can give you to put income assumptions in line with reasonableness is to take the cash value in the year you intend to start income coming from an indexed universal life insurance policy and basically multiply that number by 0.06. This would represent a 6% withdrawal rate, which from all of my testing, which has been quite rigorous, has shown to be a successful approach to ensuring adequate income generation without risking policy failure. We even showed a number of years ago with real indexed universal life insurance policies and real historical market data that using these very lofty, widespread scenarios that were supported by back-tested analysis to figure out what the average interest rate should be, laid over the income generation scenario in a very static fashion, didn't hold up when it came to real market conditions. The supposed generatable income wasn't possible because the spread would never, ever persist in real life. This had nothing to do with what the insurance company was capable of delivering, and everything to do with simply the way the market tends to work. So there was a necessary refinement that took real-life market data into consideration and showed us that projecting income from an indexed universal life insurance policy is not just about back-tested results that are then forward projected in a vacuum. We might even argue that further tempering our expectations for accumulation or income generated from indexed universal life insurance is in order because over the lifetime of an indexed universal life insurance policy, there may be changes that have a negative consequence on the overall accumulation and therefore income generatability of the indexed universal life insurance contract. And all of this has been factored in to that very simple, just take a 6% withdrawal rate piece of advice I gave you a few minutes ago. So when it comes to realistic expectations of accumulation, somewhere between 5.5% and 6% as the assumed interest rate is fine. And a withdrawal rate of at most 6% of the cash value in the year that you intend to start taking income is also going to set you up for success. If assumptions fall outside of, by which I mean higher than, those parameters, you are very likely setting yourself up for disappointment because you are looking at something that is optimistic when it comes to how things may unfold. With indexed universal life insurance, there is a lot of liberty that insurance agents and marketing agencies have when it comes to how numbers will be projected. And as the buying public, you probably don't understand all of the things that are being assumed, which understandably puts you at a little bit of a disadvantage. But the illustrations that are presented as part of the indexed universal life insurance purchase will absolutely call out the assumed interest rate. And you can do the math to figure out what the withdrawal rate assumed is when it comes to an income scenario that's being presented to you. Hey there, Brandon from the future. As I was going through the editing for this video, it occurred to me that there's a lot of information here, and it would probably be really helpful if we did a little bit more of a visual presentation to help illustrate and understand what's going on. So we'll look at a real indexed universal life insurance illustration ledger so that you can get a better sense of what I'm talking about, how this all works, and what you would specifically want to be looking at when it comes to an indexed universal life insurance proposal so that you can pick apart the various pieces and determine, is this reasonable in terms of expectations, or is this a whole lot of pie in the sky crap? Here is the illustration ledger. And some of this information is pretty unremarkable for our purposes. We're assuming a $40,000 premium. We're paying that for 20 years, and then we have a almost $1.5 million cash value balance by the time we get to our mid-60s, at which point we're going to start taking an income. And in this particular ledger right here that I have in front of you, this is assuming the maximum calculated loan, given all the parameters and assumptions. And I should mention real quickly that this page here shows us what the assumed interest rate is. So it's 6% in this case in all years, with one small caveat. So there were regulatory changes that came about in the late 2010s that changed what insurance companies could assume, especially regarding loans and index earnings as time went on, and basically sought to compress the spread between the loan interest rate and the assumed index credit. Now, in practice, it is possible that an indexed universal life insurance policy could have a 5 or 6% loan interest rate, but the cash value that's in the indexed account earns something like a 10 or 12% index credit, at which point there's a lot more interest being paid on the cash value than there is interest being earned on the loan. But for the sake of keeping things within reasonableness for projecting, because that scenario, that very wide spread, is highly unlikely to exist for each and every single year, the rules did dictate that we have to bring the loan interest rate and the index earnings assumption closer to one another whenever we are showing an income scenario in an IUL policy proposal. With this particular product that we're going to look at in the illustration, the loan interest rate is 5%, and the maximum allowable spread, if you will, between loan interest rate and index earning assumption is 0.5%. So in those years, the index credit has been reduced by 50 basis points for any value that is acting as collateral for the loan, which means for the most part, 6% is still the assumption, but it is being revised downwards slightly in order to comply with regulation for the sake of projecting income. So with a modest downward adjustment in the index credit assumption for some of the cash value in this policy, the maximum calculated annual loan amount from the policy for the sake of generating income from age 66 all the way through age 100 is this $135,852 that you see here. Now, if we take the almost $1.5 million number and we divide this $135,000, almost $136,000 into this nearly $1.5 million cash value that we assume, we'll get a withdrawal rate of 9%. Now, look, it's entirely possible that this income is sustainable by this particular indexed universal life insurance policy. I don't know. It's a pretty good one, so we should have a fair amount of optimism with regard to how well this policy will perform. That being said, a 9% withdrawal rate is very high. It's unsettlingly high, and I would argue that it is foolish to assume that sort of withdrawal rate from the cash value built up in an indexed universal life insurance policy. And again, all of my research tells me that 6% as the withdrawal rate is the right number. So, unsurprisingly, we should, if we're being good stewards of indexed universal life insurance proposals, reduce the income amount down to 6% of that nearly $1.5 million cash value assumption. And if we do that, the income number that we would target is $89,916. So we're still making all of the same original assumptions, $40,000, it's paid for 20 years, and just so you can check and cross-reference everything, 6%, that is still the number that we are assuming is the index credit in all years. You'll notice this 6.65, that's just telling us what the maximum illustratable rate is for the various index accounts that have been chosen, but I've overridden that to just be 6%. And yes, that slight reduction in the index earnings when we are taking loans against the policy is also being factored in here to arrive at what the accumulated cash value is over time. Now, if we go out to, say, age 90 and look at the cash accumulation of this policy, what we'll see is net cash value sits at a little over $3 million. It's reported here as nearly $7.5 million because this current value column does not take into account the fact that there is a very large loan balance outstanding against this policy. So $3 million is our effective remaining amount of cash available when we take a withdrawal rate of 6%. Compare that against the $614,000, almost $615,000 of remaining cash value at age 90 when we use that maximum solved income amount. The problem that may not be super apparent just by looking at the numbers unless you have a pretty good background in insurance policies or a reasonably good intuition background in mathematics is the fact that with $600 some odd thousand remaining and a $135,000 annual income, this policy absolutely must produce positive interest earnings every single year moving forward, or else we're going to run out of money. But in the scenario where we're taking $89,000 in change out of the policy and we have $3 million still remaining, we have a lot of wiggle room for a situation where we have a couple of bad years where we don't earn much, if any, interest from the indexing features. And I want to look at one other scenario which looks at where we have to adjust our income figure if we live in a world where our actual index earnings are 1% less than I originally assumed. So if we instead drop the index assumption down to 5% from that 6% number, our maximum solved income is now $99,564. Now, of course, this scenario at age 90 is still going to leave us with a relatively thin amount of money remaining, but realistically, if we did end up with this $1.3 million versus the almost $1.5 million scenario when it was 6% every single year, our withdrawal rate should still be that 6% number that I mentioned, and we should instead be taking about $79,922 each year from the policy. Now, I want to point out something that may be incredibly obvious to the more mathematically inclined, but for everybody else, this is probably not super intuitive. Notice that when we choose 6% as our withdrawal rate, and we have a 1 percentage point decline in our overall index assumption, the change in absolute dollars that we now have to live with in terms of income that we will generate from the indexed universal life insurance policy is far, far less than the absolute dollar change we had to live with when we assume a 9% withdrawal rate. This happens because as you draw closer to zero, changes become less significant in a relative sense. And the farther away from zero you are, changes become more significant in a relative sense. So one of the handy shock absorbers, if you will, of the lesser withdrawal rate practice is a smaller reduction in income we'll have to live with if the accumulation side of this story doesn't hold up quite as great as we'd hoped. So I hope all of this helps to quantify and illustrate the notion that some people will use indexed universal life insurance at its maximum possible assumptions to drive really wild numbers on paper. But fundamentally speaking, the likelihood of that scenario unfolding is very, very small. And if you don't know that because you don't have a background in insurance or you don't have a background in finance, and you take the words of the insurance agent at face value because they are a supposed professional who should know how to guide you on these things, you may end up with incredibly lofty expectations that are very likely to be unmet. But if we ratchet down the excitement and set our targets to more realistic parameters, we will absolutely create a very good, high-yielding, tax-free income from indexed universal life insurance. And now, back to Brandon from a few days ago. Also, indexed universal life insurance is, because of the volatility nature of the index earnings, much more dynamic when it comes to adjustments upwards and downwards over time, which might benefit you greatly if you use the rules I've already proposed. You may find yourself in a position where after 20 years, the cash accumulation of your indexed universal life insurance policy is actually considerably higher than that 6% assumption would have led you to believe. Now you have greater capacity to generate even more income than you thought, sticking with that 6% withdrawal rate. You might also discover that after 5 or 10 years of income generation in an indexed universal life insurance policy, that you have greater accumulation than you thought you were going to have. And again, you might be able to ratchet up the income generated from there on. But if you're too aggressive in your assumptions with indexed universal life insurance, this dynamicism can cut in both directions, meaning that you would have to make reduced assumptions moving forward, and those can be painful. So long as you set the appropriate expectations for indexed universal life insurance from the outset, yes, it absolutely can accumulate value and can accumulate a decent amount of income relative to the dollars that are committed to it. And because it's a life insurance contract, it enjoys all of the tax features that life insurance policies have. This means cash value grows tax deferred, and you can generate income tax-free income with the policy. There is a very high annual contribution limit to a life insurance policy, including indexed universal life insurance. So if you have extra resources that you're looking to save somewhere in a way that is tax advantaged, life insurance policies are a great place to look. The contribution limits are significantly higher than IRAs, and also in some cases higher than you might have available to you under several employer-sponsored retirement plans. And the tax-free nature of life insurance distributions means it does not contribute to provisional income, so it will not impact the potential taxability of Social Security income, nor will it be included in any calculation to find out if you are subject to IRMA. In general, long-term, the rate of return of an indexed universal life insurance policy is probably going to fall somewhere in the 5.5% to maybe 6% year-over-year rate of return range. That accumulated over a 20-year period and then providing a 6% withdrawal rate, especially tax-free income, does make indexed universal life insurance a compelling option for a number of people, especially those in higher income tax brackets. But that is the limit of where you should expect the results of indexed universal life insurance. It will not be market-like returns without the volatility. You will still probably accumulate a higher sum of money or achieve a higher overall rate of return with an investment in the broader equities market, at least in the United States. Whether or not that will put you in a place where you will net create a higher amount of income is a much more convoluted discussion, and it is one of the things that makes indexed universal life insurance attractive to a number of people.